Right now, Nuburu Inc., ticker BURU, is trading live at 33 cents per share, currently down about 2 cents on the session, a drop of over 5.7% on volume that is already climbing past 2 million shares. But here is the reality that price chart does not show you. The expectation is that this is a small company finding its footing. The reality is that this is one of the most intense battlegrounds in the microcap space. Right now, based on the most recent exchange data, over 26.8% of this company's entire float is sold short. This isn't just bearish sentiment, this is a full-blown siege. And what's more, this stock has a history of staggering fails to deliver, with millions of shares failing to settle on certain days back in September. This is not a normal situation, and it suggests a deep underlying conflict between those who believe this company is worthless and those who believe it is on the cusp of a complete transformation. Let's first establish the common ground, the story that has so many retail investors interested. You've likely seen the discussions on Reddit or X, the posts talking about BURU's transformation. This is the core of the bull thesis. The expectation is that Nuburu is no longer just the blue laser company. That was the old story, a company with pioneering technology for welding copper and other reflective metals, targeting the EV and 3D printing industries. That business, to be blunt, has generated almost no revenue, topping out at just a few $1,000s in recent quarters. The new story, the one the company is actively pushing, is a total pivot. Nuburu is attempting to turn itself into a defense and security technology hub. This transformation plan involves raising capital and acquiring other companies. They successfully raised $12 million in a public offering back in September, a move that heavily diluted existing shareholders but gave them the cash to execute this new strategy. They've already begun. They've announced a strategic alliance with Maddox Defense to create a joint venture focused on building next-generation drones, specifically targeting the multi-billion-dollar NATO UAV market. They have also moved to acquire other assets, completing the first phase of an acquisition for Orbit, a company specializing in operational resilience software, and taking an initial stake in Tecne, an Italian firm focused on defense electronics. The narrative is powerful. A microcap company with a tiny market valuation is leveraging its public status to roll up critical defense assets, positioning itself to capture massive government and military contracts. This is the expectation. This is the story of a $10 stock trading for pennies. It's a narrative that creates enormous excitement and draws in speculators betting on the success of this new management and their ambitious press release-heavy strategy. The stock's massive volatility, swinging from a 52-week low of near 12 cents to a high of almost $1, is a direct result of this high-stakes narrative. Now, let's challenge that narrative with the cold, hard reality. The company's own financial filings paint a picture of extreme distress. Recent reports show quarterly revenue of less than $10,000. That is not a typo. The company is, for all practical purposes, pre-revenue, yet it carries the expenses of a public entity. Its operating margins are deeply, astronomically negative. Financial analysis tools like the Altman Z-score, which measures bankruptcy risk, have placed Nuburu firmly in the distress zone. This signifies a high probability of insolvency within the next 2 years if things do not change dramatically. This is the reality that the shorts are betting on. They see a company that has failed to commercialize its legacy blue laser technology and is now attempting a desperate, high-risk pivot into an entirely new, highly competitive industry. They see the $12 million capital raise not as fuel for growth, but as a temporary life support system that will be burned through very quickly. They are betting that the acquisitions of Orbit and Tecne and the Maddox drone venture will not generate revenue fast enough to save the company from its own crushing cash burn and financial obligations. The company also recently received a warning letter from the NYSE American Exchange, not for its stock price, but for its communication, specifically for failing to provide advance notice of its new dual CEO structure. While they regained compliance, it's a sign of a company moving so fast that it's tripping over basic corporate governance. This brings us to the short-selling activity, which is the most critical factor for anyone watching this stock. That 26.8% short interest is a massive figure. It means that for every 4 shares available to trade, 1 is an IOU from a short seller. But it gets deeper. You need to look at the off-exchange short volume. On recent days, data from FINRA shows the off-exchange or dark pool short volume ratio has been consistently over 50%, even hitting 59% on some days. This means the majority of short selling is not happening on the public exchange where you and I see it, but in private trading venues. This can help mask the true selling pressure from the public tape. This is actionable data for you. You can look up FINRA's daily short volume reports yourself. When you see a high off-exchange ratio, it tells you that institutions are heavily involved. What's your take on the rising short interest? Is this smart analysis from institutions, or is it an over-aggressive position that could backfire? Even more concerning is the fails-to-deliver data. Back in September, Nuburu appeared on the Reg Show threshold list. The FTD data from that period is staggering. On September 16th, over 6 million shares failed to be delivered. The next day, September 17th, over 8.6 million shares failed to be delivered. A failed to deliver occurs when a seller does not deliver the shares to the buyer by the settlement date. While some FTDs are normal, numbers in the millions for a stock this small is a massive red flag. It can suggest that shares are being shorted that are not being properly located or borrowed, a practice known as naked short selling. When you see FTDs pile up like that, it represents a significant strain on the plumbing of the market for that specific stock. This is not a normal, healthy trading pattern. It is the footprint of a war. For investors, monitoring this data is critical. You can find FTD reports directly from the SEC. A sudden spike in FTDs, combined with a rising borrow cost, can be a sign that short sellers are overextended and are having trouble finding real shares to borrow. So, where does this leave the stock? The institutional ownership is almost non-existent, at just over 1%. Vanguard is the largest holder, but its position is tiny, likely just part of its total market index funds. This is a retail-driven stock, period. The Reddit forums and social media chatter are the primary force setting the price on the long side, while a significant, organized short contingent is betting against them on the other. This creates a binary, high-risk, high-reward setup. Looking forward, the future of Nuburu rests entirely on one thing: execution. The expectation is that this new management team, with its dual CEO structure, will successfully integrate its new defense acquisitions and start winning contracts. The bull case is that they are correct, that the Maddox JV announces a trial with a NATO country, or that the Orbit software gets a major corporate client. If any tangible revenue-generating news hits the wire, the 26.8% short interest could become rocket fuel. With a cost to borrow shares that has been elevated and a days-to-cover ratio that fluctuates with volume, any panic from shorts could induce a squeeze of incredible proportions. But do not mistake this for a safe bet. The risk of chasing a short squeeze is immense. The reality, the bear case, is that this is all a story, that the company will burn through its $12 million in cash, the acquisitions will fail to produce meaningful revenue, and the company will be forced to either reverse split to maintain its listing or, worse, file for bankruptcy. The shorts would be proven correct, and the stock would go to zero. The recent share dilution to raise that $12 million shows that management is willing to do what it takes to survive, even at the expense of the share count. Comment below with your honest take. Is this defense pivot a brilliant move or a desperate gamble? In summary, the story of Nuburu is the ultimate conflict between a compelling, forward-looking narrative and a devastatingly bleak financial reality. The expectation is a high-tech defense powerhouse being built from the ashes of a failed laser company. The reality is a pre-revenue micro-cap with a high risk of insolvency. The massive short interest and history of fails to deliver confirm that this is a polarized, high-stakes bet. The stock's next major move will not be a gentle drift. It will be a violent reaction, either validating the transformation story or confirming the bankruptcy thesis.